All right, welcome back, George. This is the time for us then to get into that question. We celebrated the repeal of the cap on interest rates. Good. But then after that, we've not seen different margins really, and we've not seen this ability for the Central Bank of Kenya to dance within that CBR. George, the question being then, this pressure to achieve a synergy between fiscal and monetary policy, is that what it is, George? Because when we look at even how this affects even interbank lending and even lending to the government has continuously got money from these banks, and in fact they will continue to get it. George, we closed 2020 with lending from banks to the government having up jumped 50%. So you put the Central Bank of Kenya monetary policy within that, where we have a lot of fiscal indiscipline or discipline, whichever side that you might be, and then you tell them, come up with a CBR. Does it tend to get difficult for you to achieve that synergy going by the physical side of things, George?
What I was going to say is, first, remember the Central Bank is the regulator of all the commercial banks in Kenya.
Yes.
And therefore, despite the fact that the interest rate cap, the Dublin rule was repealed, they still have a very big say in how banks lay their tariffs. In fact, in terms of interest rate, that is why the 7% I say is a good pointer, because it is a pointer to commercial banks that if Central Bank has not raised the CBR rate, then you can also not adjust your rates. In fact, commercial banks have maintained the rates at between 13 and 15%, mostly to the private sector. In fact, the bigger corporates are borrowing at between 11 and 12%. Coming back to the question that you're asking, there's a big disconnect between now the CBK monetary policy and the fiscal policy.
Yes.
Remember, government would want, Central Bank would want to push more credit to the economy. But in an economy where government and private sector are competing for the same resources, that is credit, then government always wins, Elijah. That is why that's what we call now government crowding out the private sector. That is why you see, despite the fact that interest rates have been quite low for quite some time now, credit creation in the private sector has been quite low as well, because most lending go into the public sector.
Yes.
If myself went to a commercial bank and the government treasury also went to the same commercial bank, Elijah, that commercial bank would want to lend to treasury first before they look my way, Elijah. That is how our government should allow commercial banks credit to the private sector. That's where the disconnect is. CBK will maintain the same rate as low as possible so that the credit creation in the private sector. On the other hand, government is taking the same and is borrowing more from the commercial banks, beating the purpose of what the MPC policy is at that particular time. But that not to say the 7% CBR rate, I think, Elijah, is still a good thing. Most private sector players can access credit at a very low rate, so to speak. In fact, Elijah, remember before the interest rate capping came into being, remember we having an interest of between 18, 19, 20, even 24% by that time. But they came down to between 13, 14, 15. The highest now I know is around 16%, which is a good thing. So we just need to refine our monetary policy and our fiscal policy so that we can achieve our objectives as a country, Elijah.
Pretty much. Gentlemen, let's move into the last question. And Robert, be ready for this. Centum Investment Company PLC is in plans to address the firm's undervaluation on the Nairobi Securities Exchange, NSE, with its stock trading at less than a third of the value of its net assets. At the virtual meeting during the company's AGM Friday last week, the board of directors indicated that the big valuation gap had persisted for long, and that it was considering several strategies to fix it. Dr. Laila Masharia indicated that the share price of the stock was not a reflection of the value of the shares that the majority of investors were holding, while insisting that the board was in the process of looking at avenues to address the main drivers of the gap. Now, the Centum stock trades at a huge 72.9% discount to the company's net asset value per share of 62.09 cents, as captured in the financial results for the year ended in March. In the recent past, the company has explored options like buying back its shares, a move that was looked as one that would reduce the volume of outstanding stock and increase the stakes of continuing shareholders. Good. Just before we cross over to Robert, let's quickly look at exactly how Centum has been performing. We do know that the cost, or they actually did get into an operating loss after tax of 1.3 billion. That's for the first 6 months of 2021. Let's cross over to the next indicator on exactly how they have performed. Look at that profit trend. They've been on the positive all the way to 2020, just that the coronavirus pandemic has been really affecting them. Now, if you look at that 2020 profit, again, you'll find one headline: they had disposed of some of their holdings as well. Come all the way to how they performed again, the exposure from Two Rivers at 1.8 billion. All right, Robert, for anybody wanting to know why Centum is undervalued on the local boost, what would be your direct answer?
Sorry, Simba, can you come again? I don't think I've got that question.
Yes, for anybody looking to understand the undervaluation of Centum shares on the local boost, what would be your direct answer, Robert?
Oh, okay. So for the undervaluation, it's a number of factors mixed in between. So we're going to start with first of all, recently there's been the real estate industry, which is actually the main area of investment of Centum, has been adversely affected.
Yes.
So we had actually Centum actually posted a loss in the last financial year. So of course, when you post a loss, you expect to see a reduction in your value in the bourse, because you expect less investor interest. So that's the first thing that actually led to its decline in its performance. Then also we have the model that they use is not something that is easily understood by investors, because remember, Centum is a company that invests in a lot of industry, in so many industries, and so that has been maybe the one of the main reasons why investors are not willing to invest in it, because this is a company that was diversified in so many industries and in so many different regions, that it makes it difficult really to place, maybe as an investor, to place their main source of income and how they're going to perform.
Yes.
So that's the main reason behind what has been happening also. It said, I mean, also remember the real estate industry has been in a decline even before COVID. So that's one of the main reasons, this attachment to the real estate industry that has been performing below par. So I will attribute it mostly to that, and also to their business model.
Pretty much. I'll be coming back to that, especially on the business model, because that's what they're saying. We need to address these areas. George, your point of view on what you like to think. I mean, when we look at Centum, it's quite an attractive stock. You will say that it's one of the most attractive stocks that we have on the local boost. But then they're saying, well, it should be at around 62 shillings as opposed to how they closed last Friday at about 17 shillings, George. That's quite a massive discount, 72%. What would be behind the way in which Centum stock is trading on the NSE, George?
The way you value a company's stock is you look at what we call the net value of the company,
yes,
or the net worth of a company divided by its outstanding shares. If you do that simple math, Elijah, basically, the net worth of Centum is around 62.9 billion, and its outstanding stocks, that is shares, is 665,440,000 shares. If you do that simple math, then the value per share, or what we call the basic value per share, is around 92 shillings per share. So yes, if the company, the share is trading at 72.9, then it is quite undervalued, as Centum put it. But that's not unique to Centum alone. It cuts across several counters at the NSE, and the reason why that has happened is there's been very quite muted activity at the NSE for quite some time now. I think because of COVID-19, and even before COVID-19 pandemic struck, Elijah, there were quite muted activity at NSE. I think NSE should do something so that there's quite some activity across these counters. That notwithstanding, Elijah, some of these cycles are expected.
Yes.
If you look at the more developed markets like the London Stock Exchange, the Shanghai Stock Exchange, and so forth and so on, there are times when the share prices are quite low, and then they start picking up. So probably these are what we call our trough, and maybe within the next year they start going up. So I think Centum, by highlighting these, they are simply telling their shareholders that hold on to our share. These shares are grossly undervalued, and we expect their values to go up in the next few years. Maybe what they are proposing to do to show up the share price is what we call cosmetic remedies to such a scenario.
Yes.
Because going back into the market to buy back your shares, of course it will increase your share price, because then you create demand for that particular counter. But remember, Elijah, that you cannot buy back all your shares. Then you cease being a public limited company. You become private company. So I think if I were in their strategy team, then I would want to leave it open so that market forces determine the share prices. I would just want to put out our figures out there for investors to read them and see that probably this is the right time that any serious investor would want to buy into Centum as they wait for the prices to increase. But investors are also cunning sometimes, Elijah. In fact, most investors would want to go into the back and play with the metrics so that the share prices go up, and then they offload their shares. That has happened before, and I would not be surprised if it happened with Centum. But if you look at their figures, Elijah, 72.9 is quite undervalued. In fact, it's undervalued by around 20 shillings, so to speak, Elijah.
Pretty much. All right, Robert, let's rush into some of those areas that George is actually spoken about this morning, and you actually started your sentiments on the same line. Let's look at exactly what they are fighting. It looks as if Centum is fighting perception, that you are in a sector and other industries that are really exposing you so much. Number one, now what they're doing is that they're going to go back and buy back their shares. And George is saying you can't buy back everything. Well, you might buy some, but it's still market forces are still going to determine how investors are going to take up the ones that you've left. Number two, they've enabled subsidiaries to borrow by themselves without essentially relying on the mother company. That's the Centum investment. And then disposing of exposure points. They've actually have those plans now, like the Two Rivers, which actually exposed them up to 1.8 billion in terms of losses in the year ended March. Do you think that what they have right now are good points to turn around the valuation of that stock, or indeed market forces are still going to win by the end of the day?
Well, it will take some time, Sim, of course.
Yes.
Remember, assuming in a perfect market, the price is a reflection of the performance of the company. And so I think Centum, if we're asking about the measures they can do, there are a couple of things that they can do. Starting with the buyback that has been on the table actually for quite a period right now.
Yeah, and they haven't actually. Yes. And they haven't actually just used it yet.
Yes. But remember, this is also something that is also reliant on your financial position. We had Nation Media Group, which did it recently, and they were in a position to do it because they had a certain amount of cash that they could at least allocate to this process of buying back their shares. When you look at Centum, in an industry that is dominated, the investments are most dominated by real estate. So this means that the issue of liquidity here is a problem. So they might have to borrow to actually fund their buying back process. So they have to look at their books, they have to look at their financial position, look at whether they can, first of all, afford to fund this buyback using their own cash as opposed to borrowing or as accessing funds from elsewhere. So that's the first situation that they're in. Also remember the late, sorry, their late director, Mr. Chris Kirubi, had actually proposed also that he was going to also increase his holdings in the company because he believed that it was increasingly undervalued. So such a move by a large investor will actually have led to an increase in the price because we will have seen increased demand. So remember, his family is also has also kept this option open, and they're also willing because they're also looking at the counter and they're seeing that this price is really below their net asset value. So there is also that option that's on the table, and they're willing to increase their stake in this company. Another thing that Centum can do actually is on the dividends. So we actually see investors are actually usually interested in stocks that offer or pay out significant dividends. So they might look at increasing their dividend yield because their policy is, I think, 30% or the last year's payout, whichever is higher. So if maybe they could adopt a more, let me say, a more accommodative dividend policy, this will lead to more interest in the counter. We have, because we usually see, although it might offer short-term solution, we have companies like PAT which offer handsome dividends, and we see their share price rising when investors are anticipating dividends because they know they'll pocket something handsomely. So sometimes we also look at that because it will actually also give investors a reason not just to buy but to hold on their shares because they anticipate a dividend payout that is handsome at the end of the year or at the end of a certain period. Then also they can look at maybe the investment strategy and look at maybe offloading some of their, they had actually pointed to reducing their allocation in real estate to something between 45 to 55% because that's their target allocation. So that's a good move because it will actually provide them with the liquidity which they can actually use to buy back their shares if that's an option. They can also use that to pay out dividends. That's an option for them. So there's that thing. Then with the cash, they can also invest in growth industries or in growth stocks such as maybe telecommunications, fintech, such industries which are showing tremendous growth in the industry. So that's also something that they can do, and maybe also restructuring their business to reduce their costs, such that investors have can see an increase in the earnings per share. So these are just some of the measures that Centum can take to increase interest, because interest is the main thing here. Remember also it doesn't usually feature. We have the most of the stocks are usually Safaricom and the banks that we have, and maybe East African breweries. So they have to come up with a strategy that will also increase interest in the counter, and this interest will now lead to at least a prop up in the price of the company.
Pretty much. It couldn't get better this morning. Take those two gentlemen back to the time that they joined us this morning, talking exactly on issues affecting the economy this morning, all the way from taxation to Centum. George, Robert, thank you very much for joining us this morning on a Business Hour.
Yeah, thanks, Simba. It's been a pleasure.
Thank you. Thank you.
Fantastic. And that's exactly what we have for you this morning. It has to be a good morning.